And Andrew, did you want to quickly test your screen share, make sure everything works real quick?
I was just thinking that. Yes, I would like to do that. Let me do that. If I hit share here, and then this is the screen that I'm going to share. I've got our presentation in PDF.
Okay,
Is this okay, or do you need me to go? I have like a massive screen otherwise, and when I go present mode, it takes up the whole thing, and it's just like a lot for me, but I can do that
gotcha.
if we need to.
No, I mean, I believe this
You can just sort of see a
looks
little
okay
bit of the
there.
extra stuff on the sides is all.
Right.
Is there a way to do that in here? I forget now. Yeah, see if I do view and I do full screen mode, then it's gonna be too much,
Gotcha. I wonder if there's a way to hide toolbars.
right? Felt like there was something in view before, but well, if this isn't too tough for people, then this would be a preference here. Does it look okay on your side, guys? Ezra and Nate?
Yeah, I mean, it's not too big of a border.
Okay.
What you should go full. Why wouldn't you go full screen?
Because my screen's huge, like it's one of
It
those giant screens and it takes up the whole thing.
right. But if you hit F11, what happens? Let's just see what happens here. Or like the
Okay.
presentation mode. This is not presentation mode.
Where?
View
There used to
there.
be a presentation mode in
Full
here, but
screen
I
mode.
don't
Full screen
see
mode.
it. I know, but then it takes up,
But
like I just was saying,
let's just see.
it's a humongous screen for me, which is not the end of the world. I can do it. I'm just gonna have to stand back. And then I can't see like the side slides. Gonna stop that for now. Ouch.
All right, Andrew, we're about 30 seconds out here.
Okay, sounds good.
Welcome back, everyone, to Money Show's virtual expo, Real Estate Plays for Profit and Income. Thank you so much for being here. It's my pleasure now to welcome Andrea Prop, Chief Strategy Officer of IceCap Group, and her team. Andrea, thank you so much. It's all yours.
Thank you so much, Mark. Thank you for having us today. We are so excited to be back here and really grateful to the Money Show for bringing these savvy investors to the platform. And thank you all for taking the time out of your day to learn a bit more about what we're doing here. I know we don't have a lot of it, I think about 30 minutes, so we'll move as quickly as we can. And hopefully you've had a chance to see some of our materials on the site. We are going to pull up our presentation here shortly so you can follow along and show you what it is we're doing here. For those of you who are looking for stable and consistent cash flow amidst a very uncertain market, asset-backed lending is a really great way to achieve this. Our company is IceCap Group, and we are a New York City-based private lender focused on short-term bridge loans that are used to rehab residential real estate. These types of loans are also known as RTLs, which stands for Residential Transition Loans. And we at IceCap specifically specialize in the more affordable workforce housing side of things across the country, but with a specific specialization in the Northeast. We've originated over $3.5 billion across 4,000 loans so far since 2017 when our firm originally formed. And over the past 5 years, we have been operating a fund platform here where we've been able to prove out that this niche subset of the market, when managed properly, of course, can deliver consistent mid-teen returns while directly addressing the need for more housing in our country. And today we're going to quickly show you how we do just that. My name is Andrea Prop, and I am the Chief Strategy Officer here at IceCap. I am responsible for managing our fund platform as well as all of our investors. And I'm joined today with Ezra Dweck, who is our president and co-founder of the firm, as well as our associate, Nate Rosenkrantz. I'm going to let the two of them say a couple words about themselves when it's their turn to chime in. But first, I am going to pull up my slides here and make sure you can all see my screen. So let's do it this way. All right, does everybody see that? We good, guys?
We're good.
Excellent. Okay. So a little bit of background on how this product came to be. I've been in finance for about 15 years, started my career at Goldman Sachs on the commodity trading floor, was there for about 5 years, went to the hedge fund world, continued on the commodity path for another few years, and it was really in 2018 that I got a unique opportunity to pivot into structured credit and real estate. And I got exposure to this unique subset of the real estate market. I had an opportunity to work with Greg Littman at Libremax Capital, who, if you've seen the movie or read the book, The Big Short, he is the centerpiece of that story. So no better person to sort of view the world through, or to learn about this world through. And really, as I was starting to learn about all the different acronyms, the CLOs, CMBS, RMBS. It was really RTLs that I became most excited about. And what I really liked about them was their short-term nature, the fact that they were directly addressing the housing crisis, but then also still delivering a really solid return for the fund. And as I started to figure out who the players were, who was involved in this space, who was really filling that void that was created after the '08 crisis happened, what I discovered was there were a lot of smaller players that were coming to the fold as private lenders to fill this void, and there weren't really a lot of great ways to get exposure as an investor. I tried to find a way to invest my own capital. There was no kind of great fund to get this exposure through. And so that brought about the idea to create it. And I was lucky enough to team up with Ezra Dweck and Joe Ovid, who had founded IceCap Group in 2017. I joined them in 2019 and have been very focused on building out our fund platform ever since. And so have done just that over the last 5 years. We have launched 3 funds in this domain. Fund 1 we launched in August of 2020. It was a $22 million fund. Fund 2 was in October of 2022. And then Fund 3, our most recent fund, and the one that we have open today, was launched in October of 23. Collectively, these 3 funds, we've raised $130 million in. Fund 3, close to $80 million, and we are targeting a $250 million total here. Let's see. I am going to. Right. So I think it's also a really great point to make really quickly that as we are growing to 250 million, that we are growing very carefully. We have a $25 million limit. We can raise no more than 25 million each quarter, and that is how we protect our returns. We don't have a drag on returns, and we're able to deploy that capital very quickly given our robust pipeline. So I am going to carry on to the sort of 7 key pillars, why our investors choose to invest with us, what sort of sets us apart. I have mentioned already, we have deployed $3.5 billion across 4,000 loans since 2017. So we have actually grown to become one of the largest private lenders in the space. We've got the fund platform, a life insurance business, as well as a term lending business here at IceCap Group. And so our operation employs about 100 people who are all dedicated to this loan origination and underwriting process. And our fund gets to really take advantage of that. Our fund certainly would not be big enough to support a team of this size. So we get the benefit of being a part of a much bigger operation. And also important, family backed by the Ovid family. They are a renowned family in the apparel manufacturing industry, and they've also had a long history of investing in real estate. And as such, they are also a part of the GP and very much aligned with our investors. They are maintaining at least a 5% stake across all of our funds, which is quite a bit more than what you would typically see from a fund GP stake. Something else you get by being an investor with us, you get obviously access to this niche subset of the market. So higher yielding loans, currently between 11 and 13% that we are able to originate. These loans are not a fit for traditional banks. I'll tell you why in a moment. But these are loans that we have become extremely excellent at both originating and sourcing and closing. And then once we couple that origination effort with our leverage and loan sales, that's ultimately how we're able to get equity-like returns without the risk of being in equity. You're much safer in this debt part of the capital stack. Strategic leverage and loan sales are really a big differentiator. That's essentially how we delivered 15.4% net last year. We're on par for 14 and 14.6% this year. And what allows us to really bring those returns up, a big part is our loan sales program. So we are oftentimes selling loans out of the portfolio. About 30% of the loans will likely get sold out of the portfolio. And when we do that, we are taking the risk off the book while still collecting an interest-only strip, which is today on average about 1.6%. That continues to flow into the fund and improve returns. The other component are our leverage, our use of leverage. We have a warehouse line we can pull from, as well as just earlier, about a month ago, we closed our first securitization, which is another source of financing for us, and also just another excellent stamp of approval with respect to our institutionalization. And then a few more here to tap into. Our loan quality is still excellent. We are first lien with personal guarantees on our loans. And our interest rates on average across the portfolio, 12.2% with origination fees of 2.2, while still maintaining high quality borrowers and high quality projects. So average FICO scores of 734. And then we've got an extremely robust origination and risk management process, which I will have Ezra go through. A low concentration risk is great. If you could set out to try and originate some of these loans yourself. We are doing a lot of $1 to $3 million loan sizes, but instead, through us, instead of having exposure to maybe one or two loans, you get exposure to an entire portfolio of these loans. And so through Fund 3, you'll have exposure to hundreds of these loans. So if one goes sideways, you're really not going to feel that in the construct of the fund structure. Last but not least, strong borrower relationships. 2/3 of our loans are closed with repeat borrowers, and 80% of our loan deal flow is proprietary to our firm. We deal with very experienced borrowers, having completed typically at least 6 similar projects. And I think all of that really shows itself if you're to look at our credit performance. Our principal losses remain extremely low, right below 0.1% firm-wide since our firm was formed. So I'm going to zoom out really quickly before I hand it over to Ezra, and just a question I often get: why are these borrowers coming to you and not going to a traditional bank to get their financing? And hence, how are we able to get these kind of higher rates? Are these loans extra risky? What's going on here? And it really comes down to a few main components. So the first one is really rooted in, ever since the 08 crisis. You've got banks are restricted with the amount of their balance sheet that they can allocate to loans that look like these loans, because these loans do not have any borrower or any tenants in the property paying rent. These are typically vacant properties. And so these are what appear on the balance sheet as non-performing assets. We need them to be non-performing. We need them not to have the renters in them, because our borrowers are typically moving in about 12 months to get this property cleaned up and back on the market, and usually adding units to it as well. The next component, the renovation component. So we release funding for the borrower to purchase the property, and then over time we release funding as they're doing the work. That requires a lot of hands-on, direct contact with the borrower, working very closely with them on a monthly basis. Very time-consuming, very cumbersome, not something a traditional bank has the time or capacity to handle. And then the biggest and most important one is our closing speed. So we're able to close these loans typically in a week or two if needed, whereas our competition from your traditional banks, those typically require months to close. So Ezra, I'm going to fast forward to a slide I really like for us to dig into, our track record and loan production. So why don't you introduce yourself and dig into this slide next?
Sure. Hi. My name is Ezra Dweck. I'm the president and co-founder of IceCap Group. I was in real estate for a few years before, about 4 years before joining with my partner Joe Oved and his family. Did a bunch on the equity side and decided I wanted to join up with a family office. One of the interesting things about the family office was we came in and they said, here's what we want from you to do. Build something that can scale and don't lose money. They said, figure out how you can get us a reasonable return. We have enough money. Don't do swing for the fences things, and make sure you don't lose. And with the real experience I had done a bunch of maybe 40 or so deals in value add real estate before that. And what I noticed was some of the deals were really good. Some of them were just okay, but the bank always got paid on all of the deals. So we said to ourselves, how can we be the bank and make sure that we are always getting paid and not losing? So that losing turned into making solid returns year over year for the last 8.5 years of being in business and the last 5+ years of having our funds in place. So that was my quick intro. Andrea, general, I told Andrea she could text me if I'm going too long. I don't see any texts coming through, so that's good. Um, so what we're looking at right now, so we built a machine over those last 8+ years. If you can click that little box away, it's distracting me.
Oh,
Built
sorry.
a
Yep.
machine over the last 8.5 years that is a real generator of deal flow. So we're doing about 1,200 deals a year. This number is 1165, and seeing a lot more than that. So we're seeing 3,700 loans a year. And that means when I say seeing, I mean loans that have already been pretty much vetted. So they've gone through either a broker who knows us well, our online systems, an in-house originator who said, okay, this is actually worth bringing to ICE, proposing, and bringing to an underwriter. So if an originator gets a call and says, hey, here's a deal, can you take a look at this? They give it a quick no, it's not on this list. So this is the 3,700 that actually get us to the level of, okay, things we're going to take seriously. Of that 3,700, we're only closing about 30% of those. And that means we're being pretty selective. So we're turning down 70% of the loans that we are looking at. And as you can see, the funnel gets tighter and tighter, and the quality is evident. The
Well,
deal
and just to
flow.
put things in perspective too, right? Like these 3,700 loans are loans that went through our system. We actually see way more than that number. These are the loans that like kind of initially fit the basic credit
Yeah,
box and went to
I
the
would
next
I would say
stage.
the real number of like stuff that we're just like people are throwing at the wall is probably about 10,000. So of the
Yeah.
10,000, probably let's say one, that 1,200 is getting through.
Yeah.
Um, okay, and where are those deals coming from? So I'm going to start from the bottom up. We have a wholesale broker network. So we built an online portal. We have a wholesale originations team. About 650 brokers logged into our portal system last week to put deals through. Those are generally cookie cutter deals that aren't necessarily right for the fund, but the fund gets the benefit of some of those relationships. Exclusive brokers. So everyone likes to talk about proprietary deal flow. These are brokers, a few of them, that have built their career creating opportunities in real estate, not just deals, building assemblages, doing different things that will create off-market deal flow for us. And the 34% is a result of those tight relationships that we've built over time. The 19% above, 19.97, just about 20% above our internal team. So we have a team of about 15 that are generating leads, calling potential borrowers up, and bringing in that true proprietary deal flow with a true direct relationship with the brokers, with these borrowers, excuse me. And then we have our traditional broker relationships, which are about 9.5%, where these are commercial real estate brokers who bring us deals because we're generally in the top 2 or 3 top private lenders in New York. Our reputation is out there and people know that we perform. And here's what we see. Our originations continue to grow. Um, People know what we do. We have money that we know how to deploy quickly, effectively, carefully, and people know that we do that well. Our reputation has been preceding us, and firm-wide originations continue to accelerate. With that being said, we have as the deal flow we have comes in, our underwriting and our selectivity for the types of loans that we allow in have gotten tighter and tighter. When I go to real estate conferences, I was at one last weekend, the National Private Lenders Association Leadership Summit for the top 50 lenders in the country. They put me on panels of what the others should be doing in underwriting. And our team has built an incredible underwriting process. We're doing deep dives on sponsors. So when other people are just pulling credit reports, we have a team. The leader of the team went to Yale and Chicago MBA and has a team below him that are doing deep dives into the sponsors, into their family members, making sure that this person isn't a shill for someone else, making sure going into beyond what a normal background check would pull, looking in public records in each municipality where they've transacted, looking at the LLCs and surrounding LLCs. So going deeper and deeper than a normal lender would, verifying their experience in meaningful ways. Something we're doing that most others aren't. Looking at the property. Is this a problem property? Is the seller a problem? Do the seller and sponsor have any connections? And those two things, and if we go to the next slide as well, really separate us from our group of peers. What does that translate into? That plus our like internal valuations translates into really, really good underwriting. And the historical performance shows just what we're talking about. So the market for this is for the delinquencies, defaults is significantly higher than what our fund has been producing. And we stay on our loans really actively. So we have a very, very active asset management team that gets ahead of issues. And because of that, we're able to keep our delinquencies at about, I'm going to say, a third to a fourth of where our even best in class peers are. And that means really protecting your money aggressively.
So I'm going to fast forward here for a minute and just get us right into Fund 3 and what it looks like today. For those of you who might be considering an investment with us, this is ultimately what you would be investing in. So, Ezra.
Okay, so what do? We do value add multifamily loans. And we don't do the very, very light rehab value add loans. We do a bit of a heavier rehab. So we're able to get to a very low loan to after repair value. It's a mix of mixed use, 1 to 4, single families and multifamily. But what we're looking for is at the end of the day that a borrower should create enough cash flow from this property to take out our loan and all of the equity they've had in. So that's what it is. We're betting heavily on our sponsors that we've done many deals with over and over again. We continue to know them very well, and they're betting on us. So
I'm happy to pull up an example, a loan example, if you want to talk through that really quickly.
sure.
Okay, so let me actually take us then quickly to our appendix. We've got a whole bunch of loan examples here. I think this one's a really good one. This is sort of our bread and butter. Why don't you chat about this?
Yeah. So this is a 10-unit multifamily 2B building. So this is in the Bronx. It currently, in the beginning, I think it was a 3-family. We do lots of loans that look like this. And what happens is the units are significantly larger than you need in that area. Our borrower comes in, wants to create an additional 7 units of housing there. We're going to fund them initially $950,000, going to hold back an additional rehab budget of $1 million. So we'll be in for 1.95 million. And our loan to after repair value, let me just do the calculation if we have a drum roll. I don't hear drums. Is about
Nate,
$3
where are the
million.
drums?
It's about $3 million. So when this is done, we'll have in 1.95 million. The value will be 3 million. And generally, our borrower will be able to take this loan out with a CMBS loan or bank loan for between 2.3 to 2.4 million dollars. This is a particular loan that we've probably done 100 times and have had I'll say 99.5% success rate. That the reason it's 100 loans and a half a percent chance because there's one that might be an issue, but I think it's not going to be, and it'll be perfectly smooth. It'll be at 100%.
Perfect. And Nate sits right in the middle of our loan origination floor, so gets to look at these loans as they come to our firm in real time, and is a good person to talk through other loan examples if anybody wants to do a follow-up call with us. But I'm going to bring us right back here to the portfolio summary slide. So now, understanding what the underlying loans look like that make up this portfolio, Ezra, why don't you talk about some of the key metrics here with respect to the fund before I take us home with the terms.
Okay, so we can talk about briefly where we are. So we do, as you can see, our focus is really on that heavy rehab. I'm looking at that bottom number. It's heavy rehab and some ground up. That's going to be the majority in our 5+ multi-family loans. And for us, the idea is multi-family loans in working class neighborhoods are the bills that get paid all the time when it's like that's the last dollar is going to pay the rent. And we're in areas where if that last dollar doesn't come to pay the rent, the city steps in and pays the rent for you. So for us, we're looking at real cash flow that's backing up the loans that we're doing, and a value creation play where we're going to get to that low loan to after repair value, which creates a giant buffer of equity and value on top of our loan. Anything specific you want me to talk about, Andrea?
Well, I think you
Other
can see here the credit performance specifically in this fund. It's been around now since October of 23, still 100% current. So
yeah.
just speaking again to strong credit
So,
performance.
so I
Our
can say something about that quickly. Just the idea is that our borrowers we don't do go down with the ship loans, right? So our borrowers are doing about $2 to $3 million projects. Each one is bite size for us and bite size for them. So they're going to do lots of them. So they want to make sure that their reputation isn't dinged by being late, by being in default, because a default puts them out of business. On a $2 million loan, they don't want to risk that. On a $50 million loan, they might have to, but on 2 million, they're going to work with us really, really tightly. And they know that we're good people to work with. So that's how we're able to maintain that credit performance of 100%.
Perfect. And then we also put together an investor letter every quarter where we share a lot of these metrics and more. And so for anybody interested in seeing that, or if you decide to invest, you will be getting those communications from us. I think important to look at the top table, the net return table. There you can see just how consistent our returns have been since the inception of this fund. You'll note that our performance so far this year is 7.3%, which equates to 14.6% annualized. That is net of all fees. And I really quite like to look at these slides as well, just to kind of show you anything else you might be considering in your portfolio. I like to say that our fund is like a replacement for an income fund in your portfolio, because we are consistently sending you a check every quarter for the amounts that are far superior to what I think you might otherwise consider in your portfolio, like the Bloomberg Ag or the JP Morgan Income Fund. You may be considering various REITs. Well, this is how we have performed so far in the first half of 2025. And this outperformance, if you want to see it for the last 5 years, is also stellar. We also like to show this. This is kind of over the life of Fund 3 and total performance since our inception. So you can see Fund 3 having delivered 27.2%. We've got only a few minutes left, so I think very important to land us here and talk about the key terms of our fund. It is an evergreen fund. We've got the ability to take in capital each quarter. Our next close is coming up September 19th. And we do, as I mentioned before, have a limit of $25 million that we can take in each quarter. And so we are actually excited to report that we've got a very large investor that is going to be joining us in the next 3 closes. We do have a limited amount of capacity still available as a result. So to those who are interested in joining us, the sooner we have subscription documents, the sooner we can count you in for that capacity. Some key terms. We do pay our distributions quarterly, typically about 6 weeks after every quarter is over. There is a 2-year lockup period, after which there's a quarterly redemption period in 25% investor level limit. So if you invest $1 million, you want to redeem after 2 years, in full, we can give you $250K over 4 quarters, assuming we have liquidity to be able to provide that. If you say, I just want $250K out, we can get that out within 1 quarter. The fee structure, important to note. So we are transitioning to a 2.5% management fee here coming up at the end of the year, and continuing on with our 20% performance rate. There is an 8% hurdle where we will not be taking performance fees until your first 8% is met. And then there's 100% catch up in between. So you get the first 8, we get the next 2, and then it's split 80-20 after that. Our minimum is typically $1 million minimum, but we have agreed to offer to any of those who come through the Money Show platform. We have adjusted our minimum to 150K. We are going to be offering that through the end of this year, and then very likely we'll be at our capacity. And so we'd love to hear from you if this is of interest to you and you'd like to consider joining us here in the next couple of months. We'd love to have you and very happy to schedule some follow-up calls. I think I'll leave it there because we do have 2 minutes to take any questions that folks might have. So Mark, are you still with us?
Yes, thank you so much, Andrea. Fantastic presentation from you and your team.
Thank you.
We have a couple of questions that came in. They're asking, how are local market conditions and rehabilitation processes assessed to ensure loans are suitable for a project?
So that is, we do a lot of work on that. We have a valuation and underwriting team that has nationwide experience. Our head of credit was the head of credit at a KKR owned note buying firm that was buying thousands of loans a year all around the country. Um, we have local experts that go down. The appraisers are making sure that what's happening is appropriate for those markets. And then we do our own digging and research per market, but we do spend a lot of time thinking about those questions.
All right, great. Thank you so much. Another viewer here, they're wondering in terms of risks, what are the main risks associated with real estate loan funds?
Sure, we've got a slide on that as there's more that we can talk through, but I think some of the key ones we often discuss with investors are these three. So I don't know, Ezra, if you want to chat about this slide.
So you have a good amount of fraud that happens in some of these. I don't want to say the funds, but in attempts at real estate lending. Basically, we're sending out wires for millions of dollars every day. People are trying to get more than they should very often. So we spend a lot of time on that. Being tied up in litigation is a risk in these type of funds. To mitigate that, we're getting personal guarantees and pledges of equity, which allow us to go through a quicker foreclosure process. Recession risks. So there are firms that are giving really high leverages. We end up with low leverage. So we generally try to de-risk in terms of market conditions. So even in 2020 or 2022, when things got shaky, interest rates went up dramatically, we still had a lot of room left in our loans. Let's see what else. Interest rate moves. Again, we build in a lot of buffer there for debt yield. And
I mean, I think it's important to mention the leverage risk too. We didn't really talk about the leverage that we use and how it works because we just didn't really have enough time, but that is something that we deploy here at a portfolio level. But it's something that we do very carefully. We maintain a leverage point between 1 to 3x. But we do it in a way, we've structured our warehouse line so there are no margin calls on that line. That's probably the biggest risk when thinking about using leverage at all. So our warehouse provider cannot come to us and say, hey, we think these assets are worth less. We need you to post margin, which would put us in a situation where we have to sell loans to meet those margin calls. So that's a good thing.
And I'll add to that, Andrea, that we were one of the only lenders in the country who's been able to do a multifamily securitization, 100% multifamily securitization, and that there is no warehouse provider that calls us up. We have the committed capital in as our effective warehouse provider, which is right now acting as the leverage on the vast majority of our loans.
Yeah, and so I'll just round that out by saying the biggest risk, or what you can expect from us is consistent mid-teen returns. If the market goes sideways, we have a black swan event. It's I don't have a crystal ball, but I would say we are so well protected, being that our average LTVs are in the 60s. So right out of the gate, we've got protection by way of the equity buffer from our borrowers. But then everything we do around managing these projects and our borrowers puts us in a really good position to be able to manage through times of stress. And so what you might see from us is maybe reduced returns in a period like that. But in terms of your principal protection, you are very well protected in the construct of our fund and the loans that we originate.
All right. Thank you so much for that thorough answer. I would greatly appreciate it. Again, thank you for joining us, everyone. And stick around. We have more great content coming your way today and tomorrow. And a big thank you, Andrea, Ezra, Nate. Greatly appreciate it.
Thank you.
Thanks so much, Mark. Thanks everybody for joining us.
Good evening.
Bye-bye.
You too.
All right, everyone. Thank you for watching. You're tuned into Real Estate Plays for Profit and Income Money Show's Virtual Expo. We'll be back with you shortly. Thanks for being here.